Good morning, Mike McCracken here. It's February 2nd, 2021. And if I were to say, what are we going to remember this time in history for, maybe down the road when it comes to investing in the stock market, the name Gamestop may come to mind. And when I say GameStop, that's certainly a household name this week, following what took place last week. But it wasn't just GameStop, it was a company by AMC, BlackBerry. Can you believe we're talking about BlackBerry in 2021 still? Costs. And so there were several other companies that were caught up into the frenzy that we saw happening last week, which has been coined the short squeeze. And so I've had quite a few phone calls and emails and text messages over the last week from you, my customers, and even from others, just wondering what in the world's going on and how is this happening and what's causing the whole stock market to have such an incredible response to what's going on with just a few companies. And so I felt it would be a good time to maybe just go through the concept of being long a stock or short a stock. And I know that for some of you, those terms might not even make a whole lot of sense yet, but I'm hoping to clarify what a short sell is versus a long and the difference in risk between the two. And then as a result of that, to show you how just a handful of stocks did affect the entire market last week. And it's going to seem very basic to some of you that know these terms and understand what's going on, but maybe hopefully you'll learn one or two things that might benefit you just in terms of your ability to not experience fear necessarily during something like we saw last week, but there was a lot of fear and anxiety growing amongst investors last week because there was some uncertainty as to what was going on and when it would stop or how it was even possible. So we've seen all kinds of good and bad from social media. Last week you saw the opportunity to use a social media platform, the group called Reddit, and that crowd funding is what allowed the short squeeze that we saw to take place. So the first thing I want to do, I have a chart up here, and this is a chart of GameStop, and I'm just going to start with that one to make some points and illustrations. But when we talk about investing long in a stock, which is what most of you are familiar with, I just want to use the idea of if we put $1,000 into a stock and that was our investment, let's say we bought it at $10 a share, I guess I would ask you the question, what's the maximum amount of money you could lose if that stock went to zero and you had invested $1,000 at $10 a share? The obvious answer is $1,000. When it goes down to zero, so for example here, if you bought it here and it went to zero, you've lost your $1,000. So that's the concept of a long investment. A short investment is a different concept. So remember, when we invest money in the stock market, the idea is to buy low and sell high, right? So we want to buy down here and sell up here. But when we sell a stock short, what's actually happening is, let's say that you clear a trade through Ameritrade, you're actually borrowing the shares from Ameritrade. There's no money invested in them yet. And that may sound strange, but that's actually what's going on. We're borrowing the shares, and then let's say that here at $10 a share or so, we sell them. So we've borrowed shares, we've sold them. That's called a short sell. And short because we actually don't really have anything in it, and if we sold them, remember, we want to buy low and sell high. So what are we hoping would happen if we sold them at $10 a share? We're hoping they'll go down in value. And as those shares go down, then at some future point, I'll have the opportunity to cover that short or buy the shares. So I'm actually doing it all in reverse, selling them first with the intent of buying them later. So I certainly want them to go down in value. If they don't go down in value, but on the other hand go up in value, I guess the question is, what do I have at risk? Remember, in a long purchase, if I put $1,000 in, the maximum amount of money I can lose is that $1,000. But if I borrow $1,000 worth of stock and I sell it, and I don't own them yet, but I sell it, at some point in time I have to buy them back. But now my risk is that that stock goes up in price. And the higher it goes, the more I've lost, and I can lose far more than the $1,000 that I invested. In fact, it's considered an unlimited, we don't know how much you can lose. So as a result of that, wirehouses such as Ameritrade or E-Trade or Robinhood, they have what are called margin requirements or margin limits. They'll allow you to borrow relative to your portfolio a certain amount of money. And when you get beyond that, then the house is at risk with you now. And so they're more than likely going to call your margin, which means you got to come up with some money, some cash, to make your investment whole. When you sold those shares short, the house is going to allow you to go so long, and then they're going to want their money. So here's what happened in GameStop last week. It was trading at $16 a share, right in here. And in just over a week, it went up to $483 a share. That's a 1,600% return for those that owned it on the long side. But if you were short it, you've lost thousands of percent on your $1,000 investment, and you owe somebody that money. So you've got to, at some point along this run, you've got to choose to buy those shares to cut your losses and to stop the bleeding. Okay, yes, if you've already noticed, I do have a different shirt on. Tried to wear the same jacket. Yesterday, when we were doing our video blog, we did have some technical issues with the device that we were using. And so, all right, we're back to it. So we're discussing the idea with GameStop of stopping the bleeding for a stock that's being pushed up or bought up. And so keep in mind that the market itself is an auction. So we have a certain number of sellers and buyers with a security like GameStop. And so who wins that battle is based off of the amount of money and the number of shares that are being purchased. And so if we've got crowdfunding through Reddit, as we have discussed a little bit already, then what happens is as they're buying more than there are sold, shoving that stock up and creating tremendous risk for the short sellers. And so as the house begins to say you're past your margin and they call your margin and we have to raise cash, there's a couple different ways that is done. One is just the customer or the investor would send in a check to cover that debt that they now are incurring through that short sell. And the other is that they would look at the rest of their portfolio and begin to redeem other stocks. Now, typically when a short seller does this, they will start with the most liquid companies, the companies with the greatest amount of float there. So usually those are big companies. But at the end of the day, it eventually affects all of the market to some degree. So one of my primary purposes for making this video was to help you understand what's going on in the overall market, since many of us did not own any of the companies that we were seeing shorted last week and the squeeze that was taking place. But anytime there's a massive short squeeze of that nature, where people are losing thousands and thousands of dollars and sometimes millions due to the height that they push these stocks, that kind of money is ultimately going to trickle down through them liquidating the rest of their portfolio and selling everything else they own to come up with cash to satisfy the margin call from the house. As we wrap this up a little bit, I'm sure it's on your mind, well, where are we in this market and what's it look like for the rest of the year? And I certainly don't have a crystal ball, but I am able to look at just some of the fundamental things that are happening that affect our stock market as a whole. Now keep in mind, it's a market of stocks, not a stock market. So even in a very, what we would consider time of distribution when stocks are going down, there are still companies relative to what they're doing and what's going on with them that can go up in the midst of a very harsh market. But we're going to talk about it more broadly and looking at the indexes, the S&P 500 and the Dow Jones and the NASDAQ. And when we look at those indexes as a whole, you might be asking the question, what's going to keep the market up, or is it going to continue to go up, or are we in for something? So none of us really know, but there are some fundamental factors that I'm looking at right now that lead me to believe the market is not maybe trading as rich as some would like us to believe. There are certainly sectors that are trading quite over what I would call fair market value, but there are also sectors trading under fair market value right now, and several of them actually that have been lagging for the last year and some as long as the last 5 years. A few things to look at. We've been going through a season of quarterly earnings here, and actually last week was the heaviest week of companies reporting earnings for the quarter. And at this point in time, just over 80% of those companies are at least hitting or exceeding their expectations on Wall Street. So that's a very, very positive factor. That means companies are beginning to recover a little bit and getting a good footing. And I'm confident that most of that will continue probably through the rest of this year. The Fed is pumping $120 billion into our system every month right now. And that's split between U.S. Treasury bonds and mortgage-backed securities. And that puts a nice foundation under the system that we operate in. And when they're doing that, it's very, very difficult for interest rates to go up. And so interest rates remaining low is another thing that as a result of drives money into stocks or what we would call equities. And so and that's simply because there's no money to be made in fixed income or perhaps in the bond market right now that would compare with the risk analysis that you would do with a stock, still justifying putting money into equities. And then finally, under this administration, we're looking at some stimulus perhaps coming very soon, more stimulus coming into the system. And regardless how we feel about that, it looks like it's coming. And when stimulus is pumped into the economy, some of that gets back into our economy through people spending it or investing it even in some situations. But ultimately, as people use that money to go buy goods and services, that does have an effect, short term at least, on our economy. Maybe a more long-term approach that they're talking about right now that seems to have bipartisan support is the idea of an infrastructure bill. And if they were to do that, that would be very, very good for our economy in relationship to jobs and things of that nature. And as those dollars trickle through, when we talk about infrastructure into buying goods and services back into people's pockets in the way of earnings, it does have a very, very good effect on an economy. So when we look at these things right now, there's reason to believe that there are some things that are very, very good for the stock market. Doesn't mean that we won't go through some ups and downs and a correction. We certainly will have ups and downs. How deep a correction would be this year, really not sure right now what the trigger for that would be. But these are some reasons for you to be feeling somewhat confident that the market maybe isn't quite as overpriced as some would lead us to believe right now. Anyway, I hope this has been beneficial for you and somewhat educational and give you an understanding of what really took place last week. So as we look back at this time in history, and you're thinking of late January 2021, probably a certain thing's going to come to your mind. Not the financial crisis and not Black Monday, but it'll be the big short squeeze. And primarily you'll think of GameStop, I'm sure. Well, it's been fun talking with you, and have a great day. And we at MFG Wealth Management are thankful for you as our customers.